What is a space analysis and how is it used as part of strategic planning? Well, this is an approach to evaluating how a company positions itself or sits to determine what would be the most appropriate competitive strategy to pursue based upon four distinct criteria. So the acronym SPACE itself stands for Strategic Position and Action Evaluation. And here is a quadrant that shows what the overall analysis entails. At the top, you'll see financial strength. At the bottom, environmental sustainability. To the left, competitive advantage. To the right, industry strengths. These are not opposites of each other, even though they're on in similar axes in this matrix. Rather, they are simply elements of the business or its environment that you will assess the extent to which this is a positive for the company or a negative for the company. Now, by doing this, you will get an outline that generally shows how one factor relates to the other, and how these factors relate to the other will give some indication of what type of strategy to pursue, whether that's a conservative strategy, an aggressive strategy, a defensive strategy, or a competitive strategy. So, with that being said, here's how it works. So, you use this to develop a strategy by taking each of these factors and assessing the company or the environment on a scale of 0 to 6. For the positive factors, such as we go back to financial strength or industry strength, these are going to be assessed on a positive. Competitive advantage and environmental stability are assessed on a negative. So the idea is that these need to be present, and that to the extent they are not, you assess a negative number to it along the graph. Okay, so the average of these factors or scores constitutes what the score is in that category. So for each of these factors, there are numerous criteria that you will use to evaluate whether there's financial strength, whether there's competitive advantage, whether there's environmental stability or industry strength. So with that being said, once you come up with a score for each of these categories, you will plot that in each of the four quadrants to represent how the company stands in that position. So let's look at the first, environmental stability. The things you would assess are technological change, inflation rate, demand volatility, price range of competitive products, price elasticity of demand, that is, how much does demand change based upon a change in price, and then pressures from substitute products. In the industry attractiveness side, you will look for growth potential, profit potential, financial stability, resource utilization, complexity of entering the industry, labor productivity, capacity utilization, and bargaining power of other manufacturers. Okay. On the competitive advantage side, you look to see, does the company hold a significant market share? Is their product quality? Where is the products or services at in their life cycle? Or what is the innovation cycle for coming up with new value propositions? Is there extreme or low customer loyalty? Is there vertical integration or combination along the supply or value chain? So all of these factors. And then lastly, financial strength. What is the company's return on investment generally? Is it highly liquid? That is, does it have a lot of cash to spend? What is the debt to equity or other ratios that are related to how much debt the company has? Profit to debt, revenue to debt, debt to equity, that type of thing. How available is capital out there in the market if the company has needs? What does the cash flow look like? And what is the inventory turnover? So if you assess all of these factors for each of these, and you're giving it a score of 0 through 6, and then each factor comes up with a score, and you take the average of that score for that category, and then you plot that category on this chart. So when you do so in this first one, aggressive, you've got high financial stability and high industry attractiveness, but not very high competitive advantage or environmental stability. In this type of scenario, it's saying an aggressive strategy is appropriate. If you switch it over and have high industry attractiveness and stability, then a competitive strategy is more suitable. A conservative strategy is when you have competitive advantage and financial stability, but low environmental stability and industry attractiveness, then a conservative strategy, and then of course low competitive advantage, low industry stability, a more defensive approach is used. So in summary and very quickly, this is how the space analysis is used to evaluate the company and its position in the given market in which it operates, to determine, based upon these factors and how you rate the company for those factors, what is the most appropriate strategy to employ.